Good morning, everyone. And just while we wait to get started, you'll see there's some polling questions up on your screen. If you could, there's 5 of them. So if you could go through them and respond, that'll assist in the post-seminar discussion. And we'll start in just a couple of minutes. Good morning, everyone, and welcome to the final pensions webinar of 2022, barring any pensions emergencies in December. I don't anticipate a further webinar till next year, but we'll end with a bang. And I'm delighted to be joined by a special guest today, Colm Fagan. Colm is one of Ireland's leading actuaries. He's the former chairman of Standard Life and the past president of the Society of Actuaries in Ireland. So I'm delighted to be joined by Colm today. Good morning, Colm.
Sorry, I had to unmute. Good morning, Stephen. Morning, everyone.
And Colm is here. The focus of today's discussion is going to be auto-enrolment in Ireland. And Colm recently won a very prestigious award from the UK Society of Actuaries on a submission called A New Approach to Auto-Enrolment Pensions. And how I came across it, because obviously I've heard of Colm before and I've seen presentations on this, but it was probably brought to my attention by a recent article that I read in the online publication, The Currency. And I won't ruin Colm's presentation where he'll go through the concept in relation to auto-enrolment, but I think the end is very powerful, the end of the article in The Currency. So if you just forgive me just for reading this out, the final paragraph in relation to Colm's proposal reads like this. It goes, either way, there's no excuse to ignore it at this point, being Colm's proposal. The endorsement given by the Society of Actuaries in the UK gives it enough credibility that, at the very least, the government needs to kick the tires. There's too much money at stake not to. So that has certainly piqued the interest, and I look very forward to hearing what Colm has to say in relation to his proposal during the second half of this presentation. The presentation is going to be divided into a small piece at the start where I'm going to go through what we know about auto-enrolment in Ireland at the moment. So what's going to happen, what the proposal, what the design is. I'm going to spend maybe 15 minutes on that. And then I'm going to pass over to Colm, who is the star of today's show, where he is going to outline his alternative proposal on AE in Ireland. So I'll move on to the next slide, please. So the focus areas today are going to be auto-enrolment. So why have we landed here? Why do we need AE? what is going to happen. I'm going to look at the current position because we do know what it's going to look like in Ireland at the moment. I'm going to look at the design. I'm also going to flag some potential issues that we possibly have with the current system. The UK, our nearest neighbour, they've had a successful AE system in place for a considerable amount of time. So I'm going to have a look at the UK experience. What lessons can and should we learn from them? And then, as I mentioned, the second half column is going to discuss the new approach and his concepts. Next slide, please. So what? Well, the problem is there's extreme pressure and it's only going to get worse on the state pension. So you can see the second bullet here is kind of quite shocking. So we've a very low pension coverage in Ireland. 34% of us will only have the state pension. And will the state pension be in its current form when we retire? I don't know. People would justifiably have concerns that the state pension may or may not be around in its current form, as it is quite generous. Will it change in relation to age and at what age people become entitled? You can even see we've tinkered around the edges recently in relation to the current proposal to increase the payment of state pension if you deferred it till a later age. So people retiring at age 70 will get an increased payment to take account of their deferral option. Auto-enrolment, another issue, is it's required because we're all living longer. I mean, pensions were designed initially with people living maybe into their mid-70s. So there was a small amount of time in which they got paid. But thankfully, we're all living longer, but that has its problems in relation to the payment of pensions. Generation of renters, this is something that really we need to look at. As the property ownership model in Ireland changes, you're looking at people who are going to be renting at a time where possibly past generations would have owned their home and no longer had to pay a mortgage on it. People are going to have to pay rent into their old age, and that's going to be factored into incomes that people require. I suppose auto-enrolment started for me and my view on it when it was first mooted in the pensions green paper in 2007. Now, not many people, you can no longer get access online to the green paper to actually see. So I've a hard copy of it, and it was very vague around the time, and it probably took around 5 years, 2011, 12, till anything really started moving in terms of firm proposals of what auto-enrolment may look like. But I think the seed of the plant that grew into AE was first found in the green paper. There's different approaches all over the world in relation to auto-enrolment and how it fits into the different pillars. I think the ones that we know worked well are the UK, which I'll discuss in a bit more detail later, and Australia and New Zealand. So they're the ones probably that we gave the most attention to when it came to designing our own AE system. Next slide, please. So this is what we know at the moment. So it's anticipated in Q1 2024. So people are going to be auto-enrolled, and then you'll have the ability to opt out after a certain amount of time. It's going to be estimated 750,000 people will be enrolled in phase 1. And the people who will be enrolled will be between age 23, 60, earn over 20,000 euros and not already in an occupational pension scheme. There'll be several opt-out points for individual as they travel along, and then there'll be a maximum earning threshold of 80,000 euros. The next slide shows a bit more detail on the anticipated contribution structure that we know for AE. So you can see the contributions, it's going to be similar to SSIA system, whereby you have an employee, employer, and a state contribution. So you can see it differs in relation to a stage, and the contributions increase over time. So years 10 plus, we're looking at a 12% overall contribution. One of the criticisms, I suppose, and I'll go into the criticisms a bit more detail, is there's no ability for AVCs. An employee can suspend contributions. Makes perfect sense to take account of people's different circumstances as they travel through the AE system. 4 different funds. It'll be interesting to see the response to the question in relation to the fund structure. Is it too low? Is it too high? There have been all sorts of commentary from different people in the pensions industry in relation to that. Drawdown will be linked to state pension age. So it'll be an ancillary benefit plugged on top to your state pension. Next slide, please. The CPA, so they're going to be the body that oversees the AE system. The CPA isn't in being yet, and I think there's various tenders in place at the moment in relation to putting in place. It will take time to get the CPA up and running, but they will have overall responsibility for the AE system. And then there will be registered providers responsible for investments. So presumably there's life officers out there that are putting together proposals or looking at the AE system and how they'd like to be involved. So if you're liaising with AE, it won't be through the individual life office, it'll be through the CPA. So everything will be routed through this CPA going forward. Next slide, please. So the problems, I mean, lots of people have commented on the issues, and indeed Colin may flag some later on during his presentation. The first really is in imposing the SSIA style tax system. It kind of runs contrary, well, not quite contrary, but it is different to the existing EET tax system that applies to pensions. So it may not be as favorable for high earners as the existing system. So there is a split in the taxation system, which will make it awkward and make it probably a bit difficult for people to understand the benefits of AE as opposed to an existing arrangement. It won't include self-employed people for the moment. That may or may not change, but that certainly is a criticism that's been landed at it. In terms of timing, you're going to have real problems, and this was seen in the UK in relation to payroll providers and actually getting the IT behind the system in place. So that's going to be a massive issue. The UK, when they brought it in, they auto-enrolled the employers. The idea in Ireland is the employee will be auto-enrolled into the system. So as you travel from job to job to job, your pot follows you. So it won't be a staging of larger employers to smaller employers. It'll be employees getting auto-enrolled. As I flagged earlier, some people criticize the fund choice of 4 of being too low. Definitely timing issues. We're approaching the end of 2023, so we're down to 12 months before kickoff time for AE. Will it be done in time? The plan is that it will, but one has to put a big question mark. As I flagged, there's a question in relation to taxation. Would higher earners be better off rowing their own boat in terms of pension as opposed to an AE system? Some people view it as a threat to the state pension and question whether or not the long-term concept is that this AE system, in taking pressure off the state pension, would really see that individuals taking a bigger responsibility in terms of funding their own retirement as opposed to the state pension. Only time will tell how that really pays out. Another question, query I've seen is that this system is of no financial benefit to the state, whereas if the state had possibly more involvement with it, that it could be beneficial to the state. That really, I mean, is it a valid question? Is it a valid concern? Possibly, but there are issues in relation to setting up a system that would benefit the state financially, and there would be certain concerns if that was the case as well. A possible issue down the line is how do you deal with employers stopping, failing, or not paying contributions whatsoever? Well, you can see it in a large similar master trust kind of scheme, the construction workers pension scheme, that there were issues during 08-09, the financial fallout, with employers just stopping paying contributions to that scheme. So there could be issues in the future with employers failing. How do you actually manage that from a admin perspective? How do you chase up all the employers failing to pay the contributions? Next slide, please. So there's other legal considerations with AE I think that we'll need to consider. So how do you identify the employees to go into the system? For instance, is an employee self-employed? You'll have all the arguments that we've had previously in relation to the gig economy, Uber drivers, and food delivery drivers. Are they self-employed? Are they employees? So anticipate these arguments in the AE system in relation to responsibility to enroll and provide a pension. AE and TUPE. So TUPE is the legislation in relation to the transfer of employees. So how will AE work with that? Hopefully it'll be simple enough, because I mentioned the pot will be attached to the employee as opposed to the employer. But that's a question going forward for the employment and pensions lawyers, how this will work from a legal perspective. Employment contracts, so pre-existing employment contracts, how will AE sit with any obligations that are in an existing employee's contract? Will AE override any sort of contractual promises in relation to contributions or whatnot? So consideration will have to be given to employment contracts and how the AE system will sit with existing contracts and employment contracts going forward. GDPR, data protection, everyone in the pensions industry is familiar with the issues there. AE is going to be the AE system is going to be a massive reservoir of information. So how will all the information be transferred from Life Office, CPA, individuals, employers? There's going to be a massive transfer of data going around. So there's going to have to be considerations in there, and definitely will cause not quite difficulties, but it'll be an area that will need analysis, and it will be an area where individuals will be concerned in relation to the transfer of their data going forward. Next slide, please. And the UK experience, it's been overwhelmingly positive. And if you look at the various reports on the AE system and what they've found, so over 60% of employees are now active members of the pension scheme. So that's a high comparison compared to where the UK was. There's a limited leveling down of employer contributions. So what I mean by that is when the AE system came in the UK, did existing pension schemes reduce their contributions to meet simply the AE requirement? And that wasn't the case. It was very limited. Existing schemes stayed as they were. The AE system was there. They got Nest and whatnot. So there was a limited leveling down, which was positive. Pretty low opt-out rate, 15%. You can see the reasons why people opted out in the UK. Affordability, too close to retirement, or the contribution rate was too low. And presumably the people who opted out with the contribution rate being too low had their own arrangements in place. As I flagged as a potential concern for Ireland, it was an issue in the UK, IT and payroll issues. Certainly as the larger employers in the UK were the first to enter the system, there were wrinkles to be ironed out. Larger schemes, if they did have large DC schemes, what they saw a lot in the UK was they were doing separate AE sections in their schemes to cater for their obligation. Smaller schemes, it wasn't really feasible to do that. So what a lot of them looked at was a master trust solution to cover the AE requirement. So similar to what we're seeing in Ireland now, a big move towards master trusts. Next slide, please. So that's where I'll leave it with my analysis of the AE system in Ireland. It's very high level, very quick analysis. But what I'd like to hand over now is to Colm to look at his alternative approach to AE, which is really the reason why we're all here today. So I'm delighted to hand you over to Colm Fagan to discuss his findings.
Thanks, Stephen, for that kind introduction. No pressure, as you say. I'm now going to bring you on a whistle-to-stop tour of a proposed smooth approach to investing auto-enrolment funds, which I believe will deliver close to double the value for money of the approach being proposed by government. Next slide, please. The key message for all savers is that higher risk investments, which I am calling equities for short in this presentation, which includes all higher risk investments, they deliver an investment return of an extra 4% or so a year on average. It can be less, it can be more. The return can even be negative on occasion, but it's a reasonably certain outcome if the investment period is long enough, and pensions are a very long-term investment. Next slide. Ideally, therefore, the best advice is to remain invested in equities forever. Switching between asset classes is for the birds. No one can predict the direction of markets. As Warren Buffett said, the only value of stock forecasters is to make fortune tellers look respectable. I can cite my own experience. I'm now 72, 73 within the next few days, yet my pension fund is still almost 100% in equities. Since I, inverted commas, retired over 11 years ago, I've earned an average return of over 10% a year, not by exercising any wonderful investment expertise, just by staying in equities through thick and thin. However, staying in equities forever leaves the individual at the mercy of the markets. This is a major fear, quite justifiably. However, it is worth noting in passing that it is a fear that can be overplayed. Retirement is a staging post, not an end point. Next slide. Lifestyle investing is the government's answer to the risk-return challenge. The default funds invest close to 100% in equities when members are young, with the proportion falling as the worker ages. If they follow the UK precedent, they will have a separate fund for each planned retirement age. The UK has 46 such funds in total. The percentages shown here, by the way, are illustrative. Given that equities deliver, on average, around 4% a year more than bonds, investing 25% in bonds implies an extra management charge of 1% a year on average. Investing 50% in bonds implies an extra management charge of 2% a year on average. It's as simple as that, but the impact is obscured by the volatility of equities. Lifestyle investing also means taking the foot off the gas just when the fund is at its maximum earning power. The potential return in a single year at age 64 for a long-term contributor is more than the total expected return in the first 10 years for a young worker. Next slide. Amazingly, the government's proposals have absolutely nothing to say about what happens at or post-retirement. It's like a car manufacturer designing a car and telling prospective buyers that they'll add a braking system when the car is on the road. Just when workers need help the most, they will be left completely on their own. And remember, we're talking here about your local garage mechanic, your worker in the local delicatessen or whatever. That is crazy. And who advises them in their hour of need? I'm reliably informed by my pension consultant friends that the 5 and 5 model of pension advice, 5% commission at the start, then wait 5 years to switch providers and earn another 5% commission by churning. That model is sadly still alive and well in Ireland of today. Next slide. This slide sets out other problems with the government's proposals. They propose to offer workers a range of risk-rated funds at all ages, in addition to the default funds, making things even more complicated. One of the problems with this is that it could leave younger, risk-averse workers in low-performing funds for life, effectively causing them to pay a management charge of 4% a year forever. Offering such a choice of funds is a waste of resources, given that the vast majority of workers, 99% for the UK's Nest Fund, have no interest in managing their own money and opt for the default fund. So if you leave the slide show for a second there. Now, forget everything you learned about pensions and open your minds to visualizing what an ideal approach to pension funding might look like. In terms of our earlier analogy, I'm going to describe a car design that includes ignition, acceleration, cruise control, and a braking system, all fully integrated. So next slide please, Sinead. Okay, next one. Yeah. Now, imagine if workers could earn equity-like returns, but ironing out the humps and hollows of market fluctuations. If that were possible, all members, young and old, active and retired, would be able to remain invested in equities for their entire membership, both before and after retirement, earning on average 4% a year more than they could earn from bonds. That would cut the cost of pensions dramatically, or alternatively allow them to get a higher pension with the same contribution. Next slide. Here's an example of what the path of investment returns would look like if we could iron out the humps and hollows of market fluctuations. The graph is for the UK market for the 30 years from 1990 to 2019. The graph would look much the same for other markets and other periods. Now go to the next slide, please, Delia. And this shows the distribution of monthly market and smooth returns for that graph that I just showed you. In the 30 years to end 2019, monthly market returns were all over the place. They fell more frequently than 1 month in every 3, falling by more than 4% once every 9 months on average. In contrast, smooth returns were positive every single month for the entire period. Next slide. This brings us to the first question. Does the smoothing formula involve a lot of subjectivity? Who decides how to draw a smooth line through the waves of market values? The answer is, next one please, Sinead, sorry. The answer is that no one draws that line. It is all done by an objective formula. I won't go through the formula that's on the screen now, but I assure you that it is not rocket science. It's very simple, straightforward formula. Now, the next slide. The table on this shows the smooth returns that the formula on the previous slide comes up with if the scheme had started on the 1st of January 2020. I specially chose 1st of January 2020 to show how the formula copes with adverse market developments. As I'm sure most of you will remember, markets fell 3.3% in January. They fell another 8.9% in February, and then followed by a massive 15.1% fall in March 2020, as investors grasped the full impact of COVID. Workers would be traumatized if this were to happen shortly after they started saving for a pension. The final line on the slide, though, shows the monthly smooth returns, which are derived by applying the formula on the previous slide, completely objectively, no human involvement whatsoever. Smooth returns are positive every single month for the 6 months of the period. Going on to the next slide, please, Sinead. This table shows yearly returns under the same smoothing formula, assuming a scheme start date of 1st of January 2000. Once again, I've chosen an adverse period because this was when the dot-com bubble burst. Market returns were catastrophic for the next few years, falling 6% in 2000, 13% in 2001, and by a massive 23% in 2002. Yet smooth returns, according to the formula, were 4% in 2000, falling to 2%, positive though, in 2001 and 1% in 2002, before rising in subsequent years. Now, if you were a worker saving for a pension and you knew nothing about stock markets, which of these two trajectories would you prefer? The first line or the second one? Next line, please. So the answer to the first question is there is no subjectivity whatsoever involved in determining smooth returns. And also, the smoothness of returns mean that member accounts can be administered like high-interest deposit accounts. This is a fantastic boon for workers who have no experience of stock markets. They can be done just like an ordinary deposit account, high-interest deposit account. Next slide, please. Now for the second question. Smooth values will sometimes be above market values, sometimes below them. Won't this cause a problem? If smooth values are, say, 120, but market values are 100, will the trustees be able to force people to buy at 20% more than market values? Similarly, if market values are, say, 100, but smooth values are 80, will the trustees be able to prevent members from getting in on the cheap or force them to sell at an artificially low price? Next slide, please. This illustrates the problem by reference to the earlier graph. For the arrow on the left, where market values, that's the brown line, exceed smooth values, the blue line, workers will want to pay more into the scheme or take out less. Conversely, for the arrow on the right, where the blue smooth line exceeds the brown market line, workers might want to stop contributing altogether because they're being asked to pay more than market value to buy into the scheme. They will also want to withdraw money at a price greater than market value. Next slide. Yeah, thanks. So this slide sets out 4 scenarios that must be avoided. My contention is that they can be avoided with automatic enrolment, but only with automatic enrolment. Under point 1, contributions are a fixed percentage of qualifying earnings, so workers won't be allowed to increase contributions when smooth value is less than market value. And by the way, I'm not allowing AVCs either. Under the second point, they won't be able to cut back on withdrawals when smooth value is less than market value. They won't be able to cancel a scheduled retirement. Retired members will also be prevented from capriciously changing the amount of their pension withdrawal. Thirdly, members won't be allowed to get out on a whim just because smooth value exceeds market value. They will only be allowed to withdraw money from the scheme at or after retirement. I'll talk about transfer values later. The fourth possibility here is the most challenging. Why won't workers stop contributing if smooth value exceeds market value? Say the smooth value is 100, but market value is only 80. Why would someone want to pay 100 when they could buy at 80 out in the open market? Next slide, please, Sinead. The answer is that the smooth fund offers better value, even if members are being asked to pay up to 170% of market value on occasion, which, by the way, I wouldn't ever see happening. Firstly and secondly, they'll get 100% investment in equities before and after retirement, all through. Thirdly, they won't have to pay for investment advice at any time. One thing that hasn't been mentioned much, but the cost of investment advice for people with small pension pots, it can take a significant bite from their pension funds. I'm saying that I'll get rid of that completely because they're just withdrawing from their account. Finally, charges are lower, particularly post-retirement. Retired members stay in the scheme and they continue to enjoy group charges for administration and asset management. Okay, next slide. Sorry. Legally, I envisage that the scheme will be structured like Nest, which is the UK's main automatic enrolment scheme, although I'll defer to Stephen and his legal colleagues on this. Member accounts will look like high-interest deposit accounts. Everyone, young and old, active and retired, will get exactly the same interest rate every single month. Workers will add to their pension pots, and so will the government and employers add to their pension pots during their working years, then withdraw money when they're retired. It's as simple as that. There's no need for advice, no brokers, no salespeople, no pension consultants to be seen anywhere. There's no need for them. When workers retire, they can take between 3% and 8% of their account each year. It's up to them to decide how much to withdraw. I have what I think is a very neat solution to the longevity challenge, but we don't have the time to look at that now. But you can read about it in the papers that Stephen will make available. People afterwards I'm very happy to give them to anyone who wants. Next slide, please. And just a few more details on this slide. Workers won't have to specify a retirement date. They'll just start drawing from their pension account whenever they stop working. They can also vary the amount withdrawn in retirement in order to deal with life's vicissitudes. Oh, I got that word right. The last 2 bullet points mention some of the small print. AVCs will not be allowed because members could, in theory at least, select against the fund depending on whether smooth values were below or above market values. AVCs will have to be affected through separate arrangements. For the same reason, departing members will not be allowed to take transfer values. Whatever is in their account, they keep, and they will continue to earn interest on it, but they must take it on and after retirement. They will also be obliged to take a gratuity at retirement. They won't be allowed to leave the money in the scheme. Now, those are, I believe, are a small price to pay for a pension that is almost double what they would get under the government's proposals. Next slide, please. The last two slides are by way of appendices. This one sets out some other features of my proposal, but I won't go through it now because for time considerations, to give as much time as possible to the discussion. And the last slide with the Appendix 2, I think there's a criticism in some quarters, completely misguided, that what I'm simply proposing is a version of with profits, which any of you who would have familiarity with the insurance industry, with the life insurance industry, that know that with profits fell into a sort of a disrepute about a decade ago for various reasons, but it is not a version of with profit. So that's really my presentation. So just finally, I do want to thank Stephen Sinead, who's been operating the slides in the background, and their colleagues in Mason, Hayes and Kern for giving me the platform to set out my approach to auto-enrolment. I really do appreciate it. And finally, I'm not asking government to accept my word that what I've set out for you today is better than what is currently being proposed. I of course believe it's better, but to quote Mandy Rice Davis, who was a woman from my generation, most of you probably wouldn't have heard of her, but I would say that, wouldn't I? What I am asking, however, is that government commission an independent evaluation to see if my proposal delivers what it says on the tin. That's all I'm asking. I'm not asking you for any more to just say, look, is this guy talking a load of rubbish, or is this reasonable what he's saying? If I'm right, the payoff, which is almost double the value for money for workers, plus a much simpler proposition, makes the evaluation well worth the relatively small cost of commissioning it. Okay, well, thank you very much.
Cheers, Colin. Thanks a lot. Certainly food for thought. I had forgot to say at the start of the presentation that there's a Q&A function, but thankfully everyone's been on Zoom long enough and I see there's oodles of questions, but feel free. I'm pleasantly surprised. Vast majority of questions are for you, Colin, thankfully. So what we'll do first is we'll have a look at the poll results, which will feed into our discussion. And please do, if you have any questions, please submit them on the Q&A. I see two questions received on the Q&A are in relation to, will the slides be shared? And they will, of course, all attendees will get the slides sent to them together with, I presume, the usual Survey Monkey on the event. And Colin also has some very helpful ancillary documents that they will be circulated for people to chew through and read through and to consider the merits from their own perspective of Colin's suggestion. So if we look at the questions, there's some very interesting responses to the polls. So should auto-enrolment proceed as planned in 2024 and you are eligible to participate, will you be opting out? So the majority of people, 59%, won't be opting out and they will be going into A&E. Now there's 41%, but that feeds into the reasons possibly I discussed, that they have other plans in place in relation to retirement. Perhaps the contributions are so low, but 59% of individuals won't be opting out. Do you think Irish payroll providers will adapt to the demands placed on them by the AE system? I think this one, you have 27% standard yes, 7% said no, and then the majority of people, 66% said yes, they'll adapt to the demands, but with additional costs. So obviously that's the majority of that one. It is currently suggested that a choice of 4 investment funds be provided to participants in the AE system. How many funds would you like to see being made available? Now, there are 4 choices here, and it seems the majority of people, 44%, 4 funds sounds about right, and then 34%, the current suggestion is too low, but if we move it towards greater than 10 funds, only 13%. So the sweet spot seems to be around 4 and less than 10 funds. Okay, and this is very interesting, actually. So the state has previously tapped into the National Pension Reserve Fund and imposed the the pension levy on private funds that we all remember from a few years ago. Would you be concerned that an AE pension pot could be used to assist the state finances during any future financial crisis? And yes to that was 64%. So 64% of people are concerned that the AE could be used to prop up the state should we enter a financial crisis like 08 or 09 again. So that is a significant amount of people who are worried about that. And this is one that should interest you, Colm. Do you think the AE pension scheme should offer a pension when members retire rather than the current proposal of a lump sum to be used to buy a pension from a broker or financial advisor? Fairly even here now, but the 55% of people said yes to that and 45% said no. So very close on that particular vote. So they're all the poll results. So I'll move to the Q&A, and feel free, if anyone's got any questions, please do submit them. Colm, this is one for you because I don't exactly know what the terminology means. Could you explain how Colm's approach is different from a UWP approach?
Okay, well, I set out in my in the last slide, I answered that particular question. So maybe if I think I can go to that. Now, I'm not sure. Could you show that that slide? The very last slide of my presentation. So I mean, there's no actuarial or board discretion. One of the whole problems with profits was there would be actuarial or board discretion on how much to pay of a bonus. So there's no discretion whatsoever. The interest rate is determined by an objective formula that I showed you on the slide. For with profit, there was a perception at times that actuaries and boards, they decide on bonus rates that it helped boost it. And first of all, there's no lump sum allowed. That was a real problem with profits, that they took big lump sums at the top of the market, and then they were left with guarantees and that. So there's no lump sums would be allowed under this whatsoever. It's purely for automatic enrolment. So that the income and outgo is very predictable. That's another big difference. No guarantees. Now, but as I said, the simulations do show, as they showed for that positive interest rates, you could have in a repeat of something close to the Japanese situation, maybe the occasional negative interest rate. But even in Japan, the way that things work, there would be positive, almost assets 100% in equities at all times. This is another problem with profits, that they were shifting money into bonds just at the wrong time when markets were falling because to protect the guarantees. There's no need for an estate is the last one, which is this buffer account for the first 30 years or no. So there's no need to hold back returns for early members, and everyone gets exactly the same interest rate. Young and old, active, retired, big or small accounts with profit, as I say, does allow a variety of this so-called reversionary and terminal bonuses, and it causes all sorts of confusions, everything. But this, I think, this sets out the differences, and so I'm glad that that question was asked, because I think I do want to nail that, which is a perception in some quarters that what I'm offering is a version of with profit. It is definitely not.
Okay, great. And we received several of the kind of same question here, Colm. Colm, how is your idea being received to date by the government departments responsible for implementing AE?
Well, I would have loved to engage with them. It's been, but they haven't engaged with me. Now, I know that they have all sorts of other things, but I would just love to sit down with them and hope that they would understand it. I think that they're saying this has come late, although I did come out with this proposal back in 2018 for them. Initially, last year, I was told, well, this had no academic credentials or whatever. I was told that last year, and that was partly what spurred me to enter the competition in the UK, sponsored by the Institute and Faculty of Actuaries earlier this year. I entered that in May, and then I was told I was told first of all in September that I was shortlisted. So the very fact that I was shortlisted showed that they took it seriously. And then in October, to be told that I was a joint winner, I got the joint first prize. So I think that has dealt with the academic credentials objection from government. And I suppose the third one that they have said is this, that they have progressed so far with their plans at this stage. I don't know how far they have progressed or why they progressed without looking at this. But at this stage, I would say that they're going to get a lot of problems with trying to implement the system as it's designed at the moment. And I do think if they have something that looks just like a high interest deposit account, which is what I'm proposing, it simplifies the administration enormously, makes things just so much easier. For instance, as you saw, the stability of the interest rates on this, it will only need to be have something calculated, say, once a quarter. Now, with unitized funds, anyone who's worked with those know you have to have daily calculations of funds. And when you have small employers and all sorts of confusion over when money is coming in and that, you're going to have all sorts of potential problems if markets are moving fast and there's uncertainty over when money is coming in. It's going to cause terrible administrative problems with the scheme as devised at the moment. So I think that what my proposal does, it offers a much more simplified way of tackling this particular problem and cutting through also the problems. So I think it would accelerate the introduction of auto-enrolment enormously. I think so. In other words, I would sense from your comments, Stephen, that you saw difficulties in implementing it in 2024. I think that if they go down this road, and they do need to commission an evaluation, first of all, they could easily meet that 2024 deadline, because all of the problems of administration are already. I should also make the point that from a financial perspective, I made the point that I think the margins of 1 year for an older person are equal to the margins in 10 years for young people. They will be getting very little revenue to cover costs in the early years. And the hope then is that you get revenue later on when the fund sizes are big, when the pension pots are big. But what they're saying is, we'll give everything over to the private sector when the pension pots are big, when people are maturing. And I said, no, that will stay with the trustees, with the scheme when it retires. And so that it's much easier to cover the costs.
Okay, thanks, Colin. Which leads me into, we've got a few similar kind of vein of question. I'll take this one myself to give you a well-earned break for a minute or so. There seems to be a lot to do to get the AE system up and running. 2024 start date is a bit optimistic. Yeah, it's optimistic, can certainly be doable if everyone gets behind there, puts their shoulder to the wheel. But if you look at the various bits and pieces, you've got to set up the CPA, put them in place. Then you have to look at the 4 providers that are going to be involved. How far along the road have they moved and looked into what's required at their end. Employers, they'll need to look at the contractual piece, their obligations. It'll take a while for decisions to be made there. Do they modify their existing schemes? Do they look at jumping headfirst into the AE system that's put in place? What do they do? Do they have the payroll providers and everything set up? So there's a lot of moving parts to it that would really need to be set up well in advance of a go date if it's the 1st of January. So a lot to do, not unachievable. It is optimistic. And then I'll probably take another question that I've seen. There's one or two. How will the AE system sit with the existing pension structures in Ireland? Well, it's going to sit side by side. So you'll have the existing DB, DC schemes and single member master trust, the whole existing remit of schemes that are there. So this will be another spoke to the wheel of pension provision in Ireland. For some employers, it'll be attractive. Others will have their own existing schemes, be it master trust or whatnot. The problem probably is the difference in the tax treatment, because for years, pensions, we've tried to simplify things, make things foolproof in a way. But by having a different tax system for the AE system that's going to be in place, you're going to lead to confusion, I can certainly see. And then people will question, is it better to go into AE or am I better to stay where I am? And that question will be asked by employees and employers. So there's certainly difficulties. And I see I've got one for you here, Colm. Why would Colm suggest there is no need for advice? Are the public educated enough to make their own decisions?
Well, first of all, remember, there's no need for investment advice, because what I'm saying is that it's like a deposit account, a high interest deposit account that someone has that they build up while they're working. Then when they retire, they take their cash lump sum and they either use that for whatever reason or they could invest that separately. But the other 75% or whatever is left in the fund, and they just withdraw it every month or every quarter for a pension. So there's no need for investment advice on that whatsoever. And, which maybe could link to another question that someone has asked here. Says, I don't think it's fair to criticize automatic enrolment on the basis of charges, since the only charge mooted so far is 0.5% in total, including management charges and intermediary remuneration. This is good value, yes, which I agree. But the issue of brokers looking for commission come retirement is not the creation of I'm not really talking about brokers, but under the current system at retirement, people will have to get advice and they have to pay for the advice. And if they have, if you have a 2 million fund and you're looking for advice, that's fine, you can pay a reasonable amount. But if you have a few 100,000 of advice, or 100,000, 150,000, the cost of that advice, no matter how it's prepared, can represent a significant proportion of that fund, and it does affect the ultimate pension you can get. And you have to look at this in the round, from cradle to grave, from the start to the very end, to see what is the cost for people. And they will have to get, under the existing proposal, they will need to get continuing advice during their retirement. As they get older, their risk appetite changes, etc. And that would prove very, very costly for people with small pension pots.
Okay, one for me here. If an employer has a contractual amount of 6% of salary contribution for their employee, but AE starts at 1.5, what advice would you offer to an employer in this type of scenario? Well, certainly, unless there's some sort of crazy legislative provision in the AE legislation when it comes out, you'd have to stick with the contractual position. Similar to when PRSAs came out, people weren't dumped out of their existing arrangements, or their contributions weren't lowered to take account of the legal lowest rung of the ladder in terms of pensions was to provide access to PRSA. So I think the advice to the employer, unless something crazy happens, is to maintain the salary contribution. Now, I think the question then would come out, where does the contribution go? Does the employee opt? Would he prefer to go into an AE-based system as opposed to the employer system? But I'd say you then look at the legislation they probably maintain in their current occupational pension scheme. But there will be discussion around what options do you offer an employee? Do they stay? Do they go? But I don't think you could move down the contribution rate to match a low run of AE. How would one for you, Colin, possibly, how would the equity portfolio be selective? A passive approach can be risky.
Well, first of all, I think it would be worldwide. It will be up to the trustees to decide, first of all. So they would seek investment advice. But I'm saying yes, 100% in what I call equities, but I do mean growth assets. But I do make the point someplace, I think in the final slide, that you could have, given the nature of the beast, that you could have probably about up to 30% maybe in unquoted illiquid investments. And they can deliver an extra return. Now, all depends how they're chosen, etc. So that is a big plus. But I would say initially, as I said earlier, the funds initially would be very small. So I would just be looking for the first few years, some sort of a passive world equity fund for investment. And then maybe later on, as the funds build up, but really they do build up so very slowly. When the funds build up, the trustees can look more widely for investment. But personally, I would be a great believer in a passive approach to investment. Now, as to whether it should be ESG guided and things like that, the main advice I think to trustees will be that they're looking, because investments won't have to be sold. You're not switching individuals as you have under the current system as they get close to retirement, moving into bonds. So you have no selling of investments. So the trustees will have a mandate to look at least a sort of a 50-year investment horizon. And that could affect their perception of how to invest. And I would hope that it would make it the more ESG conscious. Stephen, while I'm here, can I answer another question, just in case there's a misunderstanding on something? I see someone here has said there are proven advantages of advice. As an industry, we generally believe in closing the advice gap, not widening it. And of course, I accept that pension advisors or general investment advisors do offer a terrific help to people. And one of the big advantages they offer is trying to help people on the point I was making to the start on the issue of risk versus reward. How much risk are you prepared to take for a reward? And they can offer great value in that. But what the smoothing approach does, it eliminates that dichotomy completely. You can get the high risk, to get the high return at low risk, purely in the automatic enrollment. Remember the smooth blue line to the graph. So therefore, that nexus between risk and reward is cut in auto-enrollment, as I say, only in auto-enrollment. So therefore, it's not required in that. When the nexus is cut, there is no role for the advisor.
Yeah. Okay. I see there's one for me. I just keep one eye on the clock. I'll try to get as many as possible, but we have a large number of questions here. The reference occupational pension scheme, does that mean that employer-sponsored PRSAs are not occupational pension schemes? Could you offer some comments, thoughts on the difference between OPS and PRSA for eligibility? Well, defined in the Pensions Act, occupational pension scheme is a DC/DB scheme. PRSA is a different product. If you look through the Pensions Act, it's got separate definitions and whatnot. So PRSA, to all intents and purposes, is more akin to a bank account as opposed to an occupational pension scheme. And from a legislative position, they're dealt with differently. You can see even the recent changes mooted and the Finance Act on the tax treatment, but there are differences. In terms of the eligibility, occupational pension schemes, DC, DBs and whatnot, typically have their own eligibility rules in there, set out who's entitled to membership of the scheme. A PRSA is generally a product that's offered to the employees. So there are differences with the two products, certainly. Okay, the occupational pension scheme, another one. If anyone has any queries, I see there's a few of the occupational pension schemes, the PRSAs. I don't know, they kind of moved the discussion towards that, but feel free to send me on any questions and I'll be able to point you in the direction or give you an answer. Column, does Column see any challenges for smoothed return mechanism in the early years of AE until it reaches a reasonable stable state of contributions and contributors retirees?
No is a quick answer. I mean, if you go to the whatever slide that I had there showing the start of in January 2020, the model I was having there would be like the way automatic enrollment would be rolled out. I was saying you'd have 10 in the first month, it could be 10 million, whatever, 20 in the second month, 30 in the third month, and so on. And the formula just works with that. So there's no need for any balance. You don't need to have people coming in or coming out or whatever. So you can have 100% coming in at the start. You do have to have the positive cash flows at the start. So that's the answer is no. There's no problem that you can work on it from absolutely day one. And I say, if you work through that example, the formula is very simple, very straightforward. And maybe just another point there that I'm hearing you see this one about why is there reluctance to allow members to make AVCs under my proposals? I'm saying they can make AVCs, but they do AVCs separately. They get advised separately for their AVCs, but it's just that it would cause a problem for the proposal that I have, because remember, I'm saying that sometimes you're having above market values, sometimes below market values. So sometimes people could say, "Oh gosh, I'll pay an AVC if I can get in on the cheap on it." So it doesn't work for AVCs. It has to be a very specified percentage of earnings. But I'm all in favour of AVCs, of course I am.
Yeah. Okay. I'll take one for me and one for you, Colin, and then I will. People can break. I know it's Friday, approaching midday. Is the opt-out going to be 30 days for enrolment date, same as the UK, or a longer period? Employees not in favour of a pension system will be frustrated waiting for their contributions. It's going to be a short period. I do think it's around 30 days. Off the top of my head, I don't know, but it's going to be a relatively short period. And I know there's also going to be different opportunities to actually opt out as you proceed through the AE journey. So I think we'll probably take our lead from the UK in relation to opt out, and it will be a short period, and hopefully the systems are in place the way, if there's a refund or whatnot, that is proceeded quickly. One final question. A lot of for you, Colin, I think a lot of the onus passes to the trustees in relation to investment decisions. Who are the professional trustees who take on this, and does it increase costs? So any thoughts on that?
Well, yeah, first of all, I think that this, from an investment perspective, what I'm proposing is very straightforward because there is just one fund. The mandate is very straightforward. It is 100% in equities. So it's not like this replication of the UK where they have 46 separate default funds, which, by the way, you have to specify your planned retirement age. Now, if I'm a mechanic down in my local tire repair shop, I'm not too sure. I mean, I think someone has two heads if they tell me to specify my retirement date or my retirement age. For me, it's just a long-term savings account which they take when they stop working. So there's just one fund, and it's a very long investment horizon. There's going to be no worries about moving into bonds at a certain stage. And as I said, I think you just buy a default, a low-cost, equity fund at the start. And I mean, Stephen and his legal friends will tell us that if you get good legal advice on who would be the best people to buy from, and you have your advisors, you're safe. So I wouldn't see a problem from a trustee perspective. Obviously, there are major challenges for trustees in all sorts of ways, but I don't see. In fact, I see the challenges for trustees with this type of arrangement much less than with one where there is a mix of assets and where that mix varies depending on whether you're a young worker or an old worker. There is no such concern here at all.
Okay, perfect, Colm. So that's where we'll leave it. Certainly a lot of food for thought. Column slides will be circulated to all participants together with other documents that you may consider and go through the proposal in more detail. So all that remains for me is to thank Colm for joining us today to go through his proposal, and thank you all for joining us, and I wish you all a very happy weekend.